Dare say that if you got a bigger corrective move, if we went into a deeper recession, I do think that Bitcoin could potentially go even as low as my lowest worst case scenario, 9 to 10,000 before bottoming and eventually turning up in a massive. Flip this into two charts here. We have Bitcoin on one side, and I want to bring up the NASDAQ on the other. If we look at the NASDAQ from the all-time highs, right? So here's the NASDAQ. The NASDAQ, I think, is about 10% off of the all-time highs. Bitcoin is massively off the all-time highs, right? We're talking more than 50% off of the all-time highs. And so the idea is, if you had the NASDAQ just go back to the October lows, and that's that big of a drop, do we really think that Bitcoin is not going to at least retest that 15,700 level when it's only this small of a drop here? And so I would dare say that if you got a bigger corrective move, if we went into a deeper recession, I do think that Bitcoin could potentially go even as low as my lowest worst case scenario, 9 to 10,000 before bottoming and eventually turning up in a massive way. Correlation. It's just that unfortunately Bitcoin, the interest in Bitcoin has fallen dramatically and institutions are not stepping in, versus over here, the NASDAQ clearly has been the recipient of so much money flow. So my fear is, again, is that with less interest in Bitcoin only driving it up this much versus where it was at the all-time highs and so much interest in stocks, if that were to reverse, do you see more panic hitting Bitcoin and driving it back to the lows? I mean, for all we know, maybe the NASDAQ only pulls back to 12.5, but Bitcoin just alone would then go back to the lows. So I think right now there's still a risk on to risk off correlation there with the stock market, but I do think eventually it changes and becomes the digital gold that we all hope it does. I just don't think we're there yet. People in the crypto industry are way too emotional for us to be back to be at digital gold yet. Enough. 2007's top on Bitcoin marked the futures launch of Bitcoin. 2021 marked the ETF on the futures, and then the BlackRock news this time on the ETF marked the short-term top. So it's interesting how these news events trigger tops versus what everyone is hoping for is the big breakout. Now, just to be clear, I think the ETF is going to be a game changer. It's going to be a validation of Bitcoin to most retail investors, even older retail investors that don't have any exposure. But I just don't necessarily see that as a short-term catalyst versus the potential for downside via the stock market.
And I always like to give you a long-term Bitcoin forecast. Give you a 5-year Bitcoin forecast. Give them Bitcoin back, see some positive news.
I think 5 years out, you're talking at least 150,000. So I think, and that could be low end. I really do believe long term that it is the answer. And I think eventually the Fed is going back to printing. Heck, we even saw the Bank of Japan, after they talked tough and said, we're not going to do anything, they intervened and actually bought bonds like a day after saying they were going to YCC it, lose the yield curve control. So the Fed will be forced to because of the US debt, and that's the only way, is to print more money ultimately and kind of get things started. And that is ultimately the golden ticket for Bitcoin. And again, the data is clear here. I mean, you can see here, and I'll show some other charts of interest. Here's a chart that shows excess household savings. So we see during COVID, there was a massive increase in savings, but look at it getting depleted. And this only goes to about February or March of this year. And you have to think of where we are currently. So you have that aspect fighting kind of this potential for a soft landing. And then you go to something as crazy as this, and this is a really shocking chart for me. This is the median sale price of houses sold versus real median household income. And even in 2008, the cost of a house was about 350 to 400% of income for a family. You're now even well above that level. So talk about a strapped consumer. The data is showing the average car payment is now near $750 versus in 2008 it was about 350 to 400. The cost of housing or the sale of housing is 550 times the median income. These are all things, and again, I'm not even talking about food and energy prices, which now, since the last CPI report in June, have started to catapult higher. So to me, this is just more indicators. And I want to show you a couple other charts, because I think I'm a big chart person, as you know.
We know.
But look at this. Look at this. This is the forward PEG ratio, so price to earnings growth. The last time we were this high matches the .com era. And again, even higher than 2000 or 2020 or 2008 going into that period. So there is huge speculation. Another chart that I think is astronomically important to take a look at is the aggregate net speculative positioning in US Treasuries. So think about this. Treasuries are now paying 3, 4, 5, 6%, right? I mean, if you go to corporates, you can probably get 6% on something like Microsoft. Otherwise, you're in that 4 to 5% range. Bonds are less attractive to the average investor now. Average investors are saying we are less likely to invest in bonds when they pay 4, 5+% versus stocks now compared to when bonds were paying, what, 1% or thereabouts? That is crazy speculation to think about, that you can be offered 5% and still say, no, I'd much rather, even when I was getting 1%, be rather in stocks at this point. And again, it's just remarkable to think about the speculation going on. The last chart I'll show here, corporate bond yield versus Fed funds rate. And I literally could go on with you for 2 hours showing different charts, but to keep it simple, look at this chart. The red line is average corporate bond yield minus Fed funds rate. The white line is the S&P 500. Look at how every time you're down in this range, it coordinates with a major corrective move in the stock market. So again, here, this was the 99-2000 dot-com bubble bursting. S&P collapsed. We know sort of the tech sector. Here's 2007 high pivot. There's your rollover for the Great Recession. There's COVID right there. And look at where we are right now. So all of these signals and then some, to me, just say it's great to think that the Fed somehow, and listen, I love being an optimist. I think people in general should be optimists, but let's be fair. The Federal Reserve has never engineered a soft landing in the history of themselves. What makes us think that this time, when things are even crazier out there, that this time is going to be that situation?
There's never been a soft landing.
Not when you have these scenarios where you have this kind of scenario where the Fed has had to hike rates and try to land the economy. I mean, think about 2000. We still went into a recession, right? Think about 2007. You can go back to the 80s and look at all that. The Fed has never, and the part of the issue is this, is that the Federal Reserve is always following data that's lagging, right? And they also feel the pressure to get in front of the move. So in instance, in the recent periods, they talked about transitory inflation, and they basically were made the fool. I mean, let's be fair. They were so off on that. And so what do? They overreact in the other scenario by following lagging data. And so they overcompensate, which is very normal for all of us humans to do. We always overcompensate when we're wrong on this side, but ultimately they go too far on the other side and kick us into a recession. Now, listen, Jerome Powell has said he doesn't mind a recession, but I would just point out this, 2008 in January or February, Ben Bernanke came out and said, guys, we've looked at the data, there's not going to be a recession. What did we get last week? Jerome Powell finally saying, guys, there's not going to be a recession. Again, I think that to me right there is a red flag.